Howdy, folks. Welcome back. It's the weekly economic update for Monday, January 24th, 2022. I hope everyone had a great weekend out there. Mine was pretty good. Got some chores done, got some things fixed around the house. My wife came back from her cruise, so that was always that was great. So we got to spend some quality time together last night and earlier today. So like I said, hope everyone had a great weekend. We're due for some more snow here tomorrow. So for those of y'all that want to send some karma my way, think warm thoughts while I'm out there clearing the driveway probably tomorrow afternoon. So, but definitely a weird weekend. I mean, it's in one way, it seems like things are heading back towards more normalcy. I don't know how many of y'all saw Bill Maher's show, or what's his name of the show these days? I forget. Doesn't matter. But he had his guest Barry Weiss, and seems like even the people on the left are coming to the realization that this has been massively overblown, everything over the last 2 years, and they've probably been lied to. So, anyways, well, let's go ahead and dive into well, actually, let me start by saying what a wild day in the markets. I mean, if for any of those who like to ride roller coasters, here I do have a little visual for you. So let me add that back in. This is what it was like for today's market. This is what we're watching here is the old Texas cyclone at Astroworld. So whoa, it was like started out the day, market was down. The Dow was down over 1,000 points, and let's see where it closed at. Closed up 118. So I mean that's just crazy by any way to look at it. So, all right, let's get out of that. So, yeah, for those who are not comfortable with volatility, today has probably been a rough day for you. So, all right, well, let's go ahead and dive into the weekly update. All right, week on Wall Street. Stocks extended their January retreat as worries over inflation and rising bond yields continued to exert downward pressure on prices. The Dow Jones Industrial Average slid 4.58%, while the S&P 500 sank 5.68%. The NASDAQ index dropped 7.55% last week, and the internationals slipped only 0.61. So if you've been paying attention the last, probably since the last few weeks of 2021, the international space has done a lot better than domestic stocks. So we'll see if that trend continues. I personally think it will, with the the interest rate situation, and with the rate starting to go up in March or maybe April. So I think we have a little more of a slog ahead of us. It's kind of like walking through a muddy bog for the next probably a year or so, but we'll see. All right. Another turbulent week. After the holiday weekend, stocks found little respite from this month's selling pressures. The week began with the 10-year Treasury yield hitting a 2-year high that triggered a broad retreat in stocks, with technology and other high-growth companies bearing the brunt of the losses. The NASDAQ Composite officially entered correction territory and closed below its 200-day moving average for the first time since April of 2020. Stocks struggled throughout the week, rallying in early trading on both Wednesday and Thursday on solid corporate earnings and stabilizing bond yields, only to end lower on late-day selling. While last year may have been distinguished by buying the dip, this week's reflected on a different mindset, selling on the rebound. Stocks extended their losses in the final hours of Friday trading session to conclude a difficult week. Rate hike expectations rise. Recent market volatility has stemmed from predominantly from inflation concerns and how aggressive the Fed will be fighting it. This reaction reflects the market's pricing of rate hike probabilities and their estimation of the Fed's reaction. Last week's interest rate futures suggested that investors expect 4 to 5 rate hikes this year, up from 3 to 4 the previous week. Markets are pricing a 32% probability of 4 to 5 rate hikes by December, and a nearly 28% probability of 5 to 6 hikes by the end of the year. Of course, the Fed will act independently of the market, okay, but it provides insight into recent run-up in yields and continuing pressure on high-growth stock valuations. Okay, so this week in economic data, today we have the Purchasing Managers Index Composite Flash. Tuesday, we have the consumer confidence. Wednesday, new home sales and FOMC announcement. Thursday, GDP, durable goods orders, and jobless claims. And Friday is consumer sentiment. So, pretty full week for economic data. Companies reporting earnings. IBM is reporting today. Tomorrow on Tuesday is Microsoft, GE, Verizon, Johnson & Johnson, Lockheed Martin, Texas Instruments, American Express, Capital One, and Raytheon. Wednesday is AT&T, Intel, Boeing, Tesla, Abbott Labs, ServiceNow, Kimberly-Clark, and Norfolk Southern. Thursday, we have Apple, Visa, MasterCard, McDonald's, Northrop Grumman, Blackstone, Southwest Airlines, Sherwin-Williams, and Mondelez International. And Friday, closing out the week, we have Caterpillar, Chevron, and Colgate-Palmolive. All right, so that's everything for the weekly update. Do have 2 white papers that are going out in this week's email to clients. RMDs are getting a small reprieve. For the first time in nearly 20 years, the IRS has released updated actuarial or life expectancy tables. Those who take required minimum distributions from their retirement accounts may already know we use these tables to calculate your RMD. Using these new tables is relatively simple, but here are some considerations to keep in mind. What's my RMD? We determine the required amount you must withdraw annually by dividing the previous year-end balance of your qualified accounts by what the IRS calls life expectancy factor. The newest tables assume we'll live longer, which may impact the amount you'll need to withdraw. What about inherited accounts? There are some exceptions, but you must generally withdraw all assets within 10 years, regardless of your life expectancy. The Secure Act eliminates the ability to stretch your withdrawals across your lifetime if the original account owner passed it away in 2020 or later. While most RMD calculations are straightforward, the process can get more complicated if you have multiple accounts or other sources of retirement income. Before modifying your current strategy, consider reaching out to a financial or tax professional for help. And if you need some help finding said financial professional, I might know someone, so give me a call. All right. Updated premiums and deductibles for Medicare. Medicare premiums and deductibles have seen a larger than expected rise this year. For example, Medicare Part B monthly premiums have risen to $170.10, a 14.5% increase. The deductible for Part B rose $233. A Part A deductible increased to $1,556. If you didn't take advantage of the recent open enrollment period, you're not alone. According to a recent survey from MedicareGuide.com, 67% of beneficiaries hadn't looked at their choices by mid-November, with the Kaiser Family Foundation discovered that 71% don't renew their options at all during the open enrollment period. For many Americans, Medicare remains a vital program keeping healthcare affordable. I don't know about that. Open enrollment comes again from October 15th to December 7th of 2022. Definitely worth your time to familiarize these changes and the options you might select for your coverage. All righty. So I have a couple of articles that I do want to go through. The first one involves being prepared for tax time. It's titled, "Don't Throw Away This Document, Why IRS Letter 6419 is Critical to Filing Your Taxes." All right. Parents are flooded with paperwork every day of the year, but this year they absolutely want to keep track of one key letter, letter 6419, to be sent to you by none other than the Internal Revenue Service. Jerks. Don't throw this letter away. Keep it with all your other important tax paperwork, including your W-2s. Repeat, keep this letter to do your taxes. The IRS said in early January it started issuing these letters in December to those who received advanced child care credit money last year, but many parents had yet to spot this letter in their mail as of January 19th. It's important to keep an eye out for this information. Some families may want to hold off a bit when it comes to filing a return until they spot the letter, which can help file them an accurate return and avoid delays. Others who don't want to wait may need to review their own records and check their specific information at the IRS Child Tax Credit Update portal site. Someone who normally does not make enough money to be required to file a tax return will still need to keep this letter to claim any extra money that would be owed for the child tax credit when they file a 2021 federal income tax return. Even if you had zero income, the IRS notes, you could have received advanced child tax credit payments if you were eligible. All right. Families who received the advanced child tax credit in 2021, the money went out from July through December, must reconcile what they received last year with what their financial situation is this year and file a Schedule 8812. The monthly advance payments, part of the temporary expanded program, was designed so that half of the total credit amount would be paid uh, in advance monthly payments over those 6 months in 2021. The tax filer will claim the other half when filing your 21 income tax return. The IRS issued the first advance payment on July 15th of 2021. While many have not seen the letter, I reviewed a sample copy that is posted online at irs.gov. It was found on the IRS page called Understanding Your Letter 6419. Wow, that's a very creative name for that. Letter 6419 is a black and white one-page letter with an IRS logo in the top left corner. It is issued by the Department of Treasury and the Internal Revenue Service. The letter has a big box at the top stating 2021 total advantage child tax credit payments. All right, keep this letter, it's important, blah, blah, blah. So down here was a copy of what it looked like. So let me blow that up for you a little bit. All right, so anyone who's watching the video, if you get this letter in the mail, hold on to it because evidently, I don't have any kids at home, so I didn't get this. So for those who got a child tax credit, you received half your money last year, and then so you'll get a reduced amount for your taxes for this year or when you file your tax return. All right, let's go back to next article. Comes from Investors Business Daily. Fed meeting. What will double-fisted tightening mean for the stock market? This is written by Jed Graham. The abrupt shift in monetary policy from easing to double-fisted tightening in focus at this week's Federal Reserve meeting already has triggered a stock market correction for the Dow Jones, S&P 500, and NASDAQ Composite. With the stock market sell-off continuing Monday, Wall Street's increasingly hawkish bets have finally caught up with the Fed policymakers' tightening plans. If so, the stock market could see something of a relief rally on Wednesday following the Fed meeting announcements and Fed Chief Jerome Powell's news conference. There are a few reasons to treat any immediate bounce with skepticism. Fed reverse U-turn. First, considering the big picture, as recent as November, the Fed had intended for the transition from easing to tightening to be a graceful arc. Asset purchases would gradually wind down by mid-year. Then, after a brief pause, gradual rate hikes would follow, with balance sheet tightening further off in the future. Instead, the Fed is about to execute a sharp U-turn. The shift from asset purchasing to rate hikes to shrinking the balance sheet may be complete by mid-year, possibly sooner. The suddenness of the shift alone might explain the stock market's reaction. Yet, what's driving the shift is what's important. All this stuff popping up. Sorry. Yeah, what's driving the shift and what portends for the Federal Reserve policy outlook suggests what investor concern will linger. Way behind the curve, the Federal Reserve, having sworn off preemptive tightening amid too little inflation during the last cycle, has gotten itself into a fix. It has badly misjudged both the persistence of high inflation and the tightness of labor market in the COVID era. So now policymakers find themselves dramatically behind the curve with the labor market knocking on the door of full employment. The Fed's benchmark lending rate is 0 to 0.25%, even as inflation is running at 6% based on the Fed's favored measure. The main takeaway is that the Fed has its work cut out for it to shift monetary policy from being widely accommodative to something closer to neutral. That means policymakers will tighten with both fists, hiking the federal funds rate and shrinking the balance sheet, and they likely want to keep at it for a while, despite any modest softening of economic data. The main risk now is, in most policymakers' view, is that the inflation will continue to run too hot amid easy financial conditions. If that happens, the Fed could be forced to tighten even more aggressively. That's the typical recipe for a recession. At the December 14th, 15th Federal Reserve meeting, policymakers decided to wind down asset purchases in March rather than June. However, Nomura economist predicts that the Fed will move the end date for bond buys up to mid-February at the two-day meeting that wraps up at 2 p.m. Eastern. That would make sense if the Fed's overriding concern is that the policy is way too loose. While a modest adjustment, it could signal a quicker start to balance sheet normalization than some on Wall Street expect. Since March of 2020, the Fed has purchased about $4.5 trillion worth of treasuries and government-backed mortgage securities. Excuse me, one second. Sorry about that. Wall Street economists expect that the Fed will want to shrink the balance sheet by about $2.5 trillion in the coming years. That will happen naturally as bonds mature, unless the Fed reinvests the principal. Deutsche Bank economists are expecting the Fed to start small over the summer, but ramp up the balance sheet reductions to $105 billion per month by December. These economists figure that $1.5 trillion in assets would run off the balance sheet by the end of 2023, roughly equivalent to between 2.5 and 3.5 quarter point rate hikes. Fed Chief Powell's comments starting at 2 p.m. on Wednesday will be key as investors try to gauge how aggressive policymakers will be with rate hikes and quantitative tightening. When the Federal Reserve last combined rate hikes with balance sheet tightening, the stock market tanked in the fall of 2018, flirting with a bear market territory. Eventually, policymakers signaled retreat in early 2019 as rate hikes turned to rate cuts and the Fed renewed bond purchases. In dealing with the balance sheet issues, we've learned that it's best to take careful, short, methodical approach, Fed Chief Jerome Powell said on December 15th news conference. Markets can be sensitive to it, really. However, it's pretty simple. It's a pretty simple matter for the Fed to backpedal in early 2019 because inflation was tame. That raises a big question on the minds of investors. Where's the Powell put? The put option gives investors downside protection if stocks fall below a certain point. There's certainly some stock market level and some economic circumstances that would spur Powell and other policymakers to ride to the rescue. But Powell's answer to that question back in 2018 suggests the stock market would have to fall further for the Fed to react to financial market weakness. There would have to be significant correction or lasting correction, Powell said at the September 18th meeting. The stock market is in correction now, with the major indexes down Monday after skidding every day last week. The Dow Jones and S&P 500 fell more than 3% intraday Monday, while the Nasdaq plunged 4% before all losses pared to around 1% in late afternoon trade. The 10% yield was little change after pulling back from a 2-year high last week. Right. So that's everything there. I mean, my fear with what the Fed's going to do is that they will attempt to start reducing rates when there's any sort of a wobble in the stock market, or the economy like I said, the economy starts to falter. That's what I personally think will happen. That's when they were talking about the Powell's put. At what point will the stock market have to drop before the Federal Reserve jumps back in and starts pumping money back into your economy? So I personally don't want to see that. I'd like to see just let the market go through its cycle, for good or bad. 2 or 3 years ago when the Fed was raising rates and there was that taper tantrum, which we just talked about, where the Fed started buying back assets and reducing rates. I'm sure they were getting pressure from the current or from the previous administration, knowing that an election was coming up in the next year. They really didn't want to have a market downturn to fight. Who knew that COVID was going to slap them right in the face? So, okay. All right. Another article here. This is from Brian Westbury at First Trust, the 2021 finish line, fast growth and high inflation. When the fourth quarter GDP data is released later this week, it will show that 2021 finished on a high note. Unfortunately, the high note included not only strong economic growth, but also rapid inflation. This shouldn't be a surprise. It's what you get when you mix huge surge in government spending with very loose monetary policy. At present, we estimate the real GDP grew at 5.7% annual rate in the fourth quarter. If we're right, then real GDP grew 5.2% in 2021, the fastest pace for any calendar year since the Reagan boom in 1984. However, that rapid growth follows a 2.3% contraction in 2020. As a result, the real GDP at the end of last year was only up 1.4% annualized versus the end of 2019. That's slower than the pre-COVID trend in economic growth, which means that in spite of the fastest growth in decades last year, the economy remains smaller than it would have been if COVID and all the other related lockdowns hadn't happened. Glass half full, glass half empty. The same cannot be said about inflation, which is clearly higher than the pre-COVID trend. We estimate that GDP prices rose at an annual 5.9 or at a 5.9 annual rate in the fourth quarter, which would have bring which would bring the 2021 increase to 5.6%, the highest inflation for any calendar year since 1981. That follows a moderate 1.5% gain in 2020. Bear in mind that when we get the report on Wednesday, that will tell us about inventories and international trade in December and how those figures may change our projections a little. But as of now, here's how we get our 5.7 real GDP growth forecast for the fourth quarter. Consumption. Car and light truck sales fell at a 15.5 annual rate in Q4, largely due to supply chain issues. However, real inflation-adjusted retail sales outside the auto sector rose at 1%, and it looks like real services spending should be up at a solid pace. Putting it all together, we estimate real consumer spending on goods and services combined increased at a moderate 2% annual rate, adding more 1.4 points to the real GDP growth rate. Business investment. The fourth quarter should show slight growth in both business investment in equipment as well as commercial construction. While investment in intellectual property rose at a typically strong rate, combined business investment looks like it grew at a 5.3 annual rate, which would add 0.7 points to the real GDP growth. Home building. Residential construction looks like it slowed down in the fourth quarter. That's not due to less demand. Sales are trending high and inventories remain very low, but instead reflects supply chain issues and lingering problems finding willing workers. We estimate the contraction at 4.3% annual rate, which would cut 0.2 points from the real GDP growth. Government. Remember, only direct government purchases of goods and services count when calculating GDP. We estimate federal purchases grew at 1.1 annual rate in Q4, which would add 0.2 points to the real GDP growth. Trade. Imports and exports have both recovered, but imports have recovered faster, which should result in slightly larger trade deficit in Q4. At present, we're projecting that the increase in imports relative to exports will subtract 0.1 points from the real GDP growth in Q4. Inventories. Inventories look like they finally started surging in Q4. Inventories are still very low, but they're moving in the right direction. We estimate that this surge will add 3.7 points to real GDP growth. Add it all up, we get 5.7 annualized real GDP growth for the fourth quarter. Look for continued growth in 2022, but not nearly as fast as the artificial sugar high from excessive government spending runs out. So, all in all, I mean, when you when you take 2020 and 2021 and you mush them together, it looks like if you just put it on a long trend line, we're actually probably behind where we were for the trend going into, coming out of 2019. So, is it the worst thing? No. Is it the best? No. So we're kind of in that middle space right now. All right. Last article I wanted to review has nothing to do with finances, but it has to do with the war drums that our politicians are pounding on. So U.S. places up to 8,500 troops on heightened alert for possible deployment amid Russia tensions. This came from the Associated Press. At President Biden's direction, the Pentagon is putting up about 8,500 U.S.-based troops on heightened alert for potential deployment to Europe amid rising fears of a possible Russian military move on Ukraine. Pentagon Press Secretary John Kirby said Monday no final decisions have been made on deployments, which he said would happen only if the NATO alliance decides to activate a rapidly response force if other situations develop in connection with tensions over Russia's military buildup along Ukraine's border. What this is about is reassurance to our NATO allies, Kirby said, adding that no troops are intended for deployment to Ukraine itself. Kirby said Defense Secretary Lloyd Austin recommended to Biden that up to 8,500 troops be ordered to prepare for potential deployment to Europe in light of signs that Russian President Vladimir Putin is not de-escalating his military pressure on Ukraine. Kirby said he was not prepared to identify the U.S.-based units, but they were still being notified. Or because they were still being notified. We've always said we would reinforce our allies on the eastern flank, and those conversations and discussions have certainly been part of what our national security officials have been discussing with their counterparts for several weeks. White House Press Secretary Jen Psaki. Later Monday, Biden was to hold a video call with several European leaders on the Russian military buildup with potential responses to an invasion, said the White House. So I'm going to go ahead and drop off there. So, like I said, this is a scary situation, quite frankly. I mean, Ukraine and Russia are not our problem. I realize beating the war drums is good for business if you're a politician, especially in light of, everything that Washington tries to do pretty much falls flat on its face the last 2 years. So yeah, I understand. A good war is great for getting reelected and stuff like that. But I'm sorry, our children are not worth dying over a boundary disputes or whatever the case may be halfway around the world. So, if you're the kind of person who wants to pick up their phone and yell at their congressman or senator, I would strongly suggest it because we do not need to be involved in this. First of all, we're broke. We don't have any money to pay for it. Secondly, it's not our problem. And third, no Americans need to die for, what Russia and Ukraine are fighting over. So, all right. That's all. I'll leave that there. That's everything I had to say for today. I hope everyone has a fantastic Monday. I'll be back tomorrow with the Liberty Call for Tuesday. And I hope everyone has a fantastic evening. Bye-bye.